Good morning, this is Professor Mayer, and in this chapter we are focusing on the audit of property, plant, and equipment. Within our audit of property, plant, and equipment, we're going to be looking at also depreciation, depletion, all the accounts that relate to these capital assets. The sequence of the audit follows the path that we've seen in other chapters. The initial step of our audit is to assess the risk of material misstatement. We do this first by understanding the client and its environment and consider the inherent risk, including the risk of fraud. We obtain an understanding of the internal control structure so that we might be able to understand the control risk. Based upon our assessment of the inherent and the control risk, we then assess the risk of material misstatement. This risk of material misstatement will then determine the nature, timing, and extent of our further audit procedures, including additional test of controls and our substantive testing. Our test of controls and substantive testing focus on the management assertions. Let's talk about a number of these and make sure that we understand what it is that we're looking at when we are auditing property, plant, and equipment. We need to substantiate the existence of the property. We need to validate the fact that the property actually exists. We need to establish the completeness of the records related to property, plant, and equipment. This may be difficult. I worked with an organization that had a listing of property, plant, and equipment well over 100,000 items. We need to verify the cutoff of transactions, making sure that the transactions were actually reported in the proper period. We need to determine that the client has the right to the recorded property. It may be there, but it may not be owned by the client. We need to establish valuation of the property. The valuation of the property may be an issue that we need to consider right now. It may be possible that there are impairments due to events such as what's taking place right now with COVID-19. In addition, we need to determine the presentation and disclosure of property, plant, and equipment, determine that it is appropriate. There are a number of disclosures that are included in the financial statements related to property, plant, and equipment. We need to determine that these are done accurately and properly represent the value of the property. When we talk about capital, we're concerned with not only our equipment, but also capital projects. As we consider the controls that the organization has in place, we need to develop a system of testing these controls. Does the organization have a capital budget? Is there a capital budget committee within the board of directors? Within the capital budget committee and the capital budget, is there a system of authorization? And as an auditor, what we're concerned with is, are we able to test what's taking place related to the capital budget, looking at capital budget variances, determine if capital projects were approved by the budget committee. We need to also determine what the policy is to distinguish between capital and revenue or expense items. So if the requirement is that anything over $10,000 is capital, we're going to test items that are greater or around the $10,000 range to determine if in fact these items were actually budgeted correctly. We need to determine if there is a requirement that the purchase of plant and equipment are subject to the normal purchasing process. There should be a physical inventory of the property, plant, and equipment. And then finally, we need to understand how items are retired. Once they're retired due to use or other reasons, we should be able to see documentation that these items have been removed from the capital log. We are considering the risk of material misstatement due to error or fraud. The largest area related to fraud is the overstatement of assets. Expenditures for repair and maintenance may be reported as property, plant, and equipment. The primary reason that an organization is interested in doing this is to understate their expenses and thus overstate their net income. The allocation of expenses to property, plant, and equipment may be due to simple errors. And the organization needs to have a structure in place so that they can manage repairs and equipments from an accounting accounting perspective to make sure that items are appropriately categorized. In addition to this, there may be errors, and in fact, a common error is to be maintaining a piece of equipment within their accounting records that has been retired. The functionality of retiring an equipment is such that sometimes the accounting department is never notified that this equipment is no longer in use. In addition, there may be a recorded gain on an exchange of a non-monetary asset that lacks commercial substance. So let's now talk about substantive testing. As we've said multiple times, substantive testing is where we are measuring monetary misstatement. Now, the substantive testing is going to be different whether this is a new client or a continuing client. The information that you see here is primarily focused on continuing clients, but if we have a new client, what we're interested in is establishing a baseline of our assets and clearly a baseline in terms of the depreciation schedule. You notice that we are looking at changes in property over the past year. We want to vouch additions to property and plant and equipment that have occurred during the year. And again, why are we interested in this? If we've done our prior audits correctly, we have a good handle on property, plant, and equipment, and now we're looking at changes. We want to analyze the repair and maintenance expense accounts, make sure that these are properly allocated, investigate the status of property, plant, and equipment that is not currently in use, test the client's provision for depreciation, investigate any potential impairments, investigate retirement of property, plant, and equipment during the year. We also want to investigate and examine lease agreements, making sure that the organization is appropriately allocating operating and capital leases. Perform analytical procedures. Analytical procedures are critical, especially as we are considering depletion and depreciation amounts. And then finally, we're looking at the presentation and disclosure related to capital assets. Let's talk about a couple of specialized accounting rules. The acquisition of assets in non-monetary exchanges. And this basically applies also to donated assets. Perhaps you are auditing a not-for-profit organization that has received assets as part of a donation. These need to be recorded at fair value unless we cannot determine fair value or we receive the asset as part of an exchange. Self-constructed projects or self-constructed assets pose different types of problems. We are reporting the cost of direct material, direct labor, and applicable overhead to the self-constructed project. This may apply to an actual construction of a building, or it may also apply to the development of an IT system. In any event, we need to make sure that the allocation is appropriate and any allocated resources, such as labor, overhead, and otherwise, are allocated because these resources were used exclusively in the development of these self-constructed assets. When we are auditing intangible assets, we're auditing these similar to property, plant, and equipment, determining if the depreciation is appropriate, determining useful life, making sure that the depreciation is based upon the useful life and not necessarily, as an example, based upon the patent life. Intangible assets with an indefinite life, such as goodwill, need to be tested for impairment. The auditor is going to rely on business valuation specialists to value goodwill as part of the impairment test. As discussed earlier, a common error related to assets is retirements. Many times assets are retired. However, accounting is unaware of the retirement and continues to record the assets and the associated depreciation. We need to develop specific steps to discover any unrecorded retirements. For any new assets, we need to determine if they are replacement of old equipment. We need to analyze miscellaneous revenue accounts. Perhaps these assets were actually sold. If the company's product is discontinued, investigate the disposal of the disposition of plant facilities. Inquire of executives and supervisors in terms of who actually decides that an asset needs retired. Examine the retirement work orders for proper authorization and investigate any reductions in insurance coverage. This concludes our discussion for this chapter. I look forward to our next meeting.